Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5. I'm your host, and today we're exploring an expert advisor called Volatility Squeeze Momentum Shift. This strategy studies how markets coil up during quiet periods and then expand when that stored-up energy is released. It blends two volatility tools, the Bollinger Bands and the Keltner Channel, with a momentum oscillator and a trend filter. By the end of this video, you'll understand how it detects a squeeze, how it decides direction, and how it manages risk. Remember, this is educational information only and not financial advice. Let's get started. So what exactly does this expert advisor do? At its heart, Volatility Squeeze Momentum Shift is a volatility compression and expansion system. It watches for moments when a market goes quiet and its trading range tightens, a condition many traders call a squeeze. The idea is that quiet, coiled markets tend to store energy, and when that energy is released, price can expand in one direction. To measure this, the strategy layers two well-known volatility tools on top of each other. The first is the Bollinger Band, built from a moving average basis plus and minus a multiple of the standard deviation of closing prices. The second is the Keltner Channel, built from the same basis plus and minus a multiple of the average true range. When the Bollinger Bands contract entirely inside the Keltner Channel, volatility is compressed, and the strategy marks the market as being in a squeeze. Direction comes from a momentum oscillator modeled on the classic TTM momentum base, together with a longer exponential moving average that acts as a trend filter. The strategy only considers long positions when momentum and trend agree to the upside, and short positions when they agree to the downside. This EA runs on a single time frame, whichever chart you attach it to, so it can be studied on anything from intraday charts to higher time frames, and on a wide range of instruments such as major currency pairs, indices, metals, or other symbols your broker offers. It is designed for traders who are drawn to breakout and volatility expansion styles rather than constant, high-frequency activity, because it waits patiently for a squeeze to build and then release. As always, this is educational information, and trading always involves risk, including the risk of loss. Let's walk through the exact logic step by step. Every decision is made on the just completed bar at the moment a new bar opens, so the strategy does not repaint and does not act on an unfinished candle. First, the strategy builds its two volatility envelopes. It calculates a simple moving average basis over the Bollinger period, then adds and subtracts the Bollinger multiplier times the standard deviation of closes to form the upper and lower Bollinger Bands. Using the same basis, it adds and subtracts the Keltner multiplier times the average true range to form the Keltner Channel. The squeeze is considered on when the upper Bollinger Band sits below the upper Keltner line and the lower Bollinger Band sits above the lower Keltner line, meaning the Bollinger Bands are fully contained inside the channel. The strategy counts how many consecutive bars this squeeze has lasted. The actual signal is not the squeeze itself, but its release. A release is detected on the bar where the squeeze turns off after having been on. The strategy only acts on that release if the squeeze had lasted at least the minimum SlAtrMult setting, which defaults to 6. This filters out brief, insignificant compressions. Once a valid release appears, direction is decided by the momentum oscillator. Momentum is measured as the close minus the average of the Donchian midline and a moving average over the momentum period. For a long, momentum must be above 0 and rising compared with the previous bar, and the close must be above the trend EMA. For a short, momentum must be below 0 and falling, and the close must be below the trend EMA. A maximum spread guard blocks entries when trading costs are unusually wide, and only one position per magic number is held at a time. When a long is taken, the stop loss is placed the stop multiplier times ATR below the entry, and the take profit the target multiplier times ATR above it. For a short, those are mirrored. With the default settings of 2 times ATR for the stop and 3 times ATR for the target, the reward-to-risk ratio is about 1.5 to 1. Position size is set so that the distance to the stop risks a fixed fraction of account balance, 1% by default, with a fallback fixed lot and a hard maximum lot clamp. Finally, an ATR trailing stop follows the trade and only ever tightens, helping lock an open profit once a move extends. Keep in mind that no filter removes risk, and losing trades are a normal part of any strategy. Let's look at how this appears in the MetaEditor code. At the top are the input parameters you can adjust and optimize. BbMult and KcMult define the Bollinger and Keltner envelopes that detect the squeeze. Momentum period sets the lookback for the momentum oscillator, and ATR period drives the average true range used for the channel, the stops, the target, and the trailing. SlAtrMult and TpAtrMult set the stop and target as multiples of ATR. SlAtrMult controls the trailing distance. TrendEMA period is the trend filter length. MinSqueezeBars is the minimum squeeze duration, and risk percent is the share of balance risk per trade. Below the inputs are the two signal conditions. The variable go long is true when momentum is above zero, momentum is rising, and the last close is above the trend EMA. The variable go short is true when momentum is below zero, momentum is falling, and the last close is below the EMA. If go long is true, the code calls trienter for a long. If go short is true, it calls trienter for a short. Inside the entry routine, the long branch reads the ask price, places the stop loss the stop multiplier times ATR below it, sets the take profit the target multiplier times ATR above it, and submits the order with trade.buy. The short branch mirrors this exactly. It reads the bid price, places the stop above the entry, the target below it, and submits with trade.sell. Both sides size the position from the same risk calculation. Notice how symmetrical the two sides are, which keeps the logic balance between longs and shorts. Now let's bring the strategy to life on this illustrative Eurus chart. On the price panel, you can see two envelopes. The gold lines are the Bollinger Bands, and the blue lines are the Keltner Channel. Below price, the gold line in the subpanel is the momentum oscillator, with a dashed zero line separating bullish momentum above from bearish momentum below. Look at the first group of candles on the left. Price is barely moving, drifting sideways in a tight range. Notice how the gold Bollinger Bands have contracted completely inside the blue Keltner Channel. This is the squeeze. Volatility is compressed, the market is coiling, and the momentum line down below is hovering close to its zero line, showing no clear direction yet. The strategy is counting these quiet bars, and because the squeeze persists for several bars, it satisfies the minimum squeeze duration filter of 6 bars. Then watch the breakout candle. Price advances upward with a strong bullish bar, and the gold Bollinger Bands suddenly expand back outside the blue Keltner Channel. That expansion is the release, the moment the squeeze turns off. At the same time, the momentum oscillator pushes above its zero line and is rising, and price closes above the trend EMA. All three conditions agree to the upside, so the buy entry marker appears. This is the long side of the strategy in action. Follow the next few candles. Price continues to climb, each candle building on the last, while the momentum line rises further into the bullish zone, confirming the expansion has direction. The stop loss sits below the entry at 2 times ATR, and the take profit target sits above at 3 times ATR, giving a reward-to-risk ratio of roughly 1.5 to 1. As price advances, the trailing stop quietly tightens behind it. Price reaches the take profit target, and the long trade is complete. Now the market cools off. Price pulls back from the highs and drifts lower, slipping back below the trend EMA. Watch the bands again. The gold Bollinger Bands contract once more and settle inside the blue Keltner Channel. A new squeeze is forming, this time higher up on the chart and below the moving average. The momentum line fades back toward zero and then dips beneath it. The market is coiling again, storing energy for its next move. Then comes the downside release. A strong bearish candle pushes price lower, and the Bollinger Bands expand outside the Keltner Channel to the downside. The squeeze turns off. The momentum oscillator is now below its zero line and falling, and price closes below the trend EMA. This time, all three conditions agree to the downside, so the sell entry marker appears. This is the short side, and notice how it mirrors the long exactly. From there, price steps lower candle by candle. The momentum line sinks deeper into the bearish zone, confirming the expansion. For the short, the stop loss sits above the entry and the take profit target below it, again at 2 and 3 times ATR. Price slides down to the take profit target, and the short trade closes. That is the complete rhythm of volatility squeeze momentum shift. Wait for the Bollinger Bands to compress inside the Keltner Channel. Wait for the release. Then let momentum and the trend filter choose the direction, whether long or short. Of course, not every squeeze resolves this cleanly, and in real markets releases can be false or reverse quickly, which is exactly why the strategy uses stops, a trend filter, and fixed fractional sizing to manage that risk. And that brings us to the end of our deep dive into volatility squeeze momentum shift. We covered how the strategy detects a volatility squeeze by watching the Bollinger Bands contract inside the Keltner Channel, how it waits for the release, and how it uses a momentum oscillator and a trend EMA to decide whether to go long or short. We also looked at its ATR-based stops, targets, trailing stop, and fixed fractional position sizing. Remember, everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.